Hello and welcome to another chapter on US taxation. So today we are going to discuss upon who is required to file taxes. In the previous chapter, we explored the major type of federal taxes in the United States. We learned about federal income tax, payroll taxes, capital gain tax, estate and gift tax, and federal excise taxes. So now we understand that what taxes exist in the US tax system. But this leads us to a next very important question. Who is actually required to file these taxes? Does everyone needs to file these tax returns? And is filing required only when tax is payable? So the answer might surprise you. In the United States, filing a tax and paying taxes are two completely different concepts. Many people must file the tax return even when they owe no tax at all. So in this chapter, we begin module 2, taxpayer concepts, where we shift our focus from taxes to taxpayer themselves. So we will learn who must file the federal tax return, what is the income threshold for filing, important exceptions to the filing rules, filing requirements for the individual, business, investors, and employers, filing requirement for estate, gifts, and the excise taxes. And by the end of this chapter, you will clearly understand who is required to file taxes in the United States. So we'll move to the first agenda slide and look at the key topics that we're going to cover as a part of this chapter. So let's move to the agenda slide. Okay, so the key agenda items that we are going to cover today are why tax filing requirement matters, and we'll look at the legal obligation to file, and what's the difference between the filing versus the paying of taxes. Type of the federal taxpayer: individuals, business and corporations, investors, employers, and estate and gift givers. We'll quickly have an understanding on the filing requirement for business and corporations, filing requirement for investment and capital gains, filing requirement for estate and gift tax, filing requirement for federal excise tax, and we'll quickly have a quick synopsis on what we have covered as a part of this chapter. So with this, we'll move to the first slide, why tax filing requirement matters. Okay, so now we will talk about why tax filing requirement matters. So filing of tax return is not equal to paying of taxes. So this is typically a scenario for the US taxation. In the US taxation system, filing a return and the paying taxes are two different obligations. So which means that even if you do not require to pay any taxes, still you have to file the return. A person may need to file the return even if no taxes is owed. Filing is required for the compliance, reporting, refund, and the legal records. So which means that in case the taxes has been deducted, but the taxes has been deducted over and above the minimum threshold limit, and then in that case, that individual needs to file the return to get the refund from the government. So legal compliance. So why do we require to file the return? We'll understand that concept in detail in this slide. So first is that legal compliance requirement. So US tax laws requires the taxpayer to report income annually once certain conditions are met. Failure to file can result in the penalties, interest, legal notices, and the loss of the future tax benefit. For example, a person earns $30,000 but doesn't file a return. Even if tax was fully withheld, IRS may issue a non-filing notices to penalty. So which means that the obligation is to file the return, even if taxes is not required to be paid, but obligation is there to file the return. And those obligation needs to be managed by the individual while they file the return, and it has to be mandatory. And if at all they skip or they fail to file the return as per the timelines, then they are liable to pay the interest and the penalty, and also they are liable to get the notices from the IRS. So claiming tax refund is another reason why the individual needs to file the return. Many employees have tax withheld from their salary throughout the year. Filing return is the only way to claim the excess tax back. For example, tax withheld by the employee is 4,000, the actual tax liability is 2,800. To file the refund and to get the tax refund of 1,200, the individual needs to file the return. So creating official income records. So tax returns serves as official proof of the income, which is required for the loan application, visa, immigration, credit cards, and the government benefits. So move to the next slide, and we have a few more reasons why tax filing is required for the U.S. Citizens and the people who are required to file taxes in the U.S., whether they are U.S. resident, and not the US citizen. And even if they are not US citizen and not US resident, and even if they're non-resident, then also they have to file the return. So we'll move to the next slide and look at some of the more reasons why tax filing is required. Okay, now we'll look at three more reasons. In the last slide, we look at three reasons for filing the tax return, which was for the compliance and record purpose, for official records, and definitely just to claim the refund from the department. Now we'll look at the three more reasons why tax filing is required. So next is the reporting of all type of the income. So IRS receives the income data from the employers, banks, brokers. Filing ensures that return matches with the IRS record. Examples: bank reports interest income of $500 through a form 1099 INT. If not reported, IRS send a mismatch notice. Likewise, reporting losses and the future benefit. So filing allows the taxpayer to report the losses and use them later. Examples: capital loss carry forward, business losses, depreciation benefit. So if you try to compare this with the how Indian income tax operates largely on the same methodology, wherein nowadays we have a concept of AIS, which is annual information system report, which disclose all the information which is being submitted by the multiple third parties, which includes the banks, mutual funds, or any kind of the payment by any employer in the form of the salary, or any interest payment by any individual to any other person. So all this information is getting reflected in the AIS. So likewise, the tax filing is required, and if at all some mismatch occurs, then individual has to provide the reason for not including that particular income in their return filing. And last reason is avoiding the IRS notices and the penalties. So non-filing triggers the automated IRS notices, estimated tax assessment, and the penalties and the interest. So which means that the paying of the taxes will not immune you from not filing the return, even if you're not liable to any taxes because it has been deducted by the employer. Then still you have to file the return to make sure that you have filed the return and the record is there with the IRS, and they then use that information for future purpose. So we'll move to the next. Okay. Now we looked at the major objective to file the return by the SSC. We'll also look at some of the advantages if at all return is being filed regularly. So filing helps the individual to stay legally compliant, to avoid the penalties, get the refunds, recover the excess taxes, build the financial records so that loans and visas can be granted, and the report losses. So which means that losses can be adjusted in the future, and that makes sure that this this uh, this will initiate the tax saving in the future when lower tax needs to be deducted while adjusting those losses. Now, filing a tax return is not about paying taxes. It protects your money, your records, and your compliances. So you're not required to file a federal income tax return if your income is below the certain limit. So this is a threshold limit as well. And if at all the income is below that threshold limit, then individual is not required to file the tax return. They are largely linked with the standard deduction. So we'll talk about this in the detail in the upcoming slides. And if a gross income is greater than the filing threshold, then it has to file the return. And threshold depends upon the filing status, age, and the type of income. So we'll talk about our threshold limit in the subsequent slides, and we'll also look at some of the areas wherein the filing is still required, despite the fact that it is below the threshold limits, which are normally there are certain exceptions to it, and we are going to look at all those exceptions in the upcoming slides. So we'll move to the next slide. Okay. Now, in this slide, we're going to talk about certain limits. In the last slide, we mentioned that there's a limit beyond which individual has to file a return. So we'll talk about that limit here. So for salary, wages in the single earner, the limit is $14,000. So if it is greater than 14,000, then filing is required when gross income exceeds the standard deduction. 14,000 is the standard deduction, and if it is income is more than that, then we have to file the return. So when it is being salaried, which is merit, if you file jointly, then limit increases to two times, which is 28,000 total income, and then the combined income threshold needs to be looked into. For interest and dividend, count towards the 14,000 threshold added to the total income. Business income, if a sole proprietor is there, then greater than 14,000 is the total income, and this is the threshold limit. Self-employment, if it is greater than $400, then individual has to file the return. So limit reduced substantially here. So for self-employment income, if it is more than 400, then individual has to file the return. For capital gain, any capital gain needs to be filed the return. There is no exemption to it, no threshold to hit. Rental income, any rental income or loss, there is no threshold to hit. Unemployment income count towards the 14,000 threshold. Social security benefits for 25,000 combined income. So filing may be required depending upon the income of an individual. Gift received, no limit, no filing required. Recipient never files. So which means that this needs to be filed by the person who give the gift, not the person who received the gift. Gifts given, so 17,000 per year per recipient, and then file form 709, and state transfer if a state is more than 13 million at the time of transfer. So which means that largely the limit exists for the salaried individual, interest and dividend, business income which is sole proprietor, and then there is no threshold limit for the capital gain, rental income, and the threshold limit for estate is very high, which is 13 million, and for gift it says 70,000 per recipient and will be paid by the person who make the gift. So we'll talk about all this in detail as we move forward in the individuals section of the salaries, capital investments, and all those separate heads of the income. But in this slide, its objective is to just to give you a brief overview that how threshold is being applied and what is the threshold for each class of the income. So we move to the next slide. Okay, now we'll talk about certain exceptions. So we talk about there are certain exceptions that even if it is not having any limit, then still we have to file the return. So which means that limit does not play any role here. So what are those? So for self-employment income, if it is even more than 4,000, then one has to file the return. So freelancers, consultants, gig workers must file to calculate the self-employment tax. Example, freelance income is 800, salary is 0, filing is required. So you had a federal income tax withheld and want the refund. If taxes were deducted from the salary, filing is required to claim the refund. Salary is 6,000, tax withheld 500. So even if it is less than 14,000, you need to file the return to get the refund. So you sold an investment property. Any sale of the stock and mutual fund, crypto, real estate requires reporting. Capital gain losses. Example, stock sold for 100 gain, return is required because there is no exemption limit, which is or there is no exception limit or threshold limit which is applied to this particular kind of an income. You receive advance tax credit or the subsidies. Applies to health insurance, market credits, child tax credits, advance payments. IRS required reconciliation through tax return. You own special taxes, even if with the low income filing required. For example, if special self-employment tax is there, which is like in the case of the self-employed, early retirement withdrawal penalty is there, household employee tax is there. So in these cases, even if the income is less than the threshold limit, still you have to file the return. You want to claim the tax credit. So low income taxpayer often file to claim earned income tax credit, child tax credit, education credit. So we'll talk about all these elements in subsequent slides when we talk about the detail that how these credits, tax credits are allowed. IRS and filing notice. If IRS receive income from Form W2 but no returns filed, then they may require the filing. So typically these are those cases wherein return is required to be filed even if the limit of 14,000 for an individual has not been reached or it has not been breached as well. So we'll move to the next slide then. Okay. Now we'll quickly have a look at who are the type of the federal taxpayers. So who can be federal taxpayer? So we'll first talk about the individual taxpayer. So the most common category includes the employees earning salary, freelancers and the gig workers, investors earning interest and dividends, retirees receiving the social security, and primary form is form 1040. So this is for those people who earn income, whether through salary, investment income, they receive the retirement benefit in the form of social security. There's a limit which we discussed in the last slide, which is I think 25,000, and then they have to file the return. An employee earning salary and investing in the stocks need to file the return. So business or self-employed taxpayer, individuals operating a business without a corporation, which includes freelancers, consultants, small business owners, gig economy workers. Taxes include income tax and the self-employment tax. So form is Schedule 3 and Schedule SE. So example of freelance graphic designer earning consulting income. So which means that individual taxpayer earning salary, interest income, investments income, and retiring benefit, plus self-employed taxpayer in the form of freelancers, gig workers, or small business owners. They need to file the return for income tax and for self-employment tax. So we'll move to the next slide and see the rest of the categories. Okay. So then we have the corporate taxpayer, C corporations, so separate legal entities from owners. So they pay corporate income tax on the profits, and the form is 1120. Employers, businesses that pay salaries to the employees. So They need to file the returns for the payroll tax withholding, reporting wages, and depositing payroll taxes. This is largely the withholding tax return that employers do file with the IRS so that it get matched with the individuals when they file their return individually. Investor and the asset owners. So taxpayers earning income from the stocks in the mutual funds, bonds, real estate, cryptocurrency, which includes the capital gain tax and the dividend tax. They also need to file their returns just to make sure that they have complied with the regulatory requirements of paying the taxes which arises at the time of the capital gain or the receipt of the dividend. So we'll move to the next slide and see a couple of more categories who are paying the taxes. Okay, so we have two more categories, which is includes the estate of the deceased person. So anyone who died and then estate transferred to another person, that person or the estate of that person needs to file the return. And there's a threshold attached to it. We looked at it and it was 13 million a dollar. And then we have the gift givers, individual transferring the large amount of wealth during the lifetime, they have to file the return. Whereby if they make the gift to an individual recipient, which is more than 70,000 per gift, then they have to file the return. So then we have individuals, just a quickly snapshot here. So individual, mainly they file the return for the income tax. Businesses, they file the return for the income plus self-employment tax. Corporations for the corporate tax, employer for the payroll tax, investor for the capital gain tax, estate for the estate tax, and the gift givers for the gift tax. So these are largely the kind of the taxpayer who needs to pay the taxes. This is the kind of the income they earn. So we'll move to the next slide. Okay. So as we talked about the threshold limit in the last slide, we are not going to talk about now going to talk about the filing requirement for business and the corporation. So businesses must file even if no tax is owed. So unlike individual, most businesses must file the tax return every year, regardless of the profit or loss. This is compliance requirement, not just the tax payment requirement. So self-employed individuals, which includes the freelancers, consultant, gig workers, small business owners, file as a part of their personal return using the form 1040 plus schedule C plus schedule SC. Filing trigger is when must file if the net self-employment income is greater than $400. For example, freelancer earning the income of 1000, expenses 200, net profit is 800. So filing is required because self-employment income is more than $400. Now, when we talk about the partnerships, partnership do not pay income directly. So, which means that unlike India scenario wherein partnership also is assessed to the tax and they have to pay the taxes, here it is not that case. They do not pay taxes here. They simply file the computation of the profit and report the business income in the form of the Schedule K1 to the partners, and that is being filed with the authorities as well. Partner then has to include that income in their individual return, and then they have to file the return basis their individual status. So example, partnership, two partners in consulting firm of profit of one like is there. A partnership files the 1065 form and partners reports the income individually. Here, partnership firm do not pay taxes. The taxes is being paid by the individual on the share of the profit which accrues to them. Partnership firm need to file a form K1 to the authorities, which has all the details of the incomes and expenses and the attributable share of the profit, which is being paid to the partners. So we'll move to the next slide. Okay, now we have another category here. So we are talking about the C corporation, which is nothing but the corporate entities. So corporates are separate legal taxpayer. They must file the return every year, even if there is no revenue, no activity, loss incurred. They have to file form number 1120. So for example, a started company with zero revenue, expenses and 15,000 loss must file a return. Then we have S corporation, which is pass-through entities. They just file the return even if there is no, because this is largely a pass-through company and their income flows to the shareholders only. So these companies still need to file the return just to ensure that whatever pass-through has happened, that is reported properly. And then employers have to file the returns in the form of the payroll taxes filing. Businesses pay employers must file the form 994I, which is the quarterly payroll tax return. 941, sorry, quarterly payroll tax return, 940 annual unemployment tax return, and W2 and W3 employee wages report. So, which means that business file the return because of the income reporting, payroll obligation, investor governance reporting, and the legal compliances. So, which means that employer has to file all these return just to make sure that they have deducted the proper taxes while paying the salary to their employees, and they have deposited their taxes so that at the time of the reconciliation and the matching, those taxes will be reconciled with the income which is being reported by the individuals. And if that it is matched, then it is fine. Otherwise, notices would be sent to the individual for not reporting their income, which is being filed by the employer. So we'll move to the few more categories like investors and capital gains. We'll move to the next slide then. Okay, so now we have a filing requirement for investments and the capital gain. So when investor must file a tax return, so taxpayer must report the investment income and the asset sale to the IRS even if gain is small. So investment activity almost always create a filing requirement. So filing requirement when the taxpayer sells a stock to the mutual fund, sells bond, sells cryptocurrency, sells real estate, receive the dividend, then they have to file the return. Filing requirement for the capital gain, you must file the return if you sell an investment, even if profit is very small, there is a loss or total income is below the filing threshold limit. Then filing requirement for capital losses. Losses must also be reported to offset the gains, carry forward losses to the future years. Example, capital losses there, stock bought is 5,000, sold as 3,000, losses 2,000, filing is required. So which means that for investment and the capital gains, which is like reporting the dividend and the capital gain or the capital loss, return requirement is mandatory, and there is no threshold that is being applied at the time of filing the return, even if it is less than the standard deduction limit, which is for an individual. For investment and for dividends and for capital gains, this does not apply. There is no threshold limit for this. So we'll move to the next slide. Continuing with the last slide only. So filing requirement is for dividend income, which is again falling under the same category of investment and the capital gain. Filing requirement for the interest income. Then we also have filing requirement for the cryptocurrency transactions. All these transactions when incurred, so it does not fall under the category of the threshold. So whenever these transactions are incurred and there is income, even if of minimal amount, that needs to be reported so that authority has the clear uh, information on all the capital gain transaction, dividend income, or the cryptocurrency transaction that has happened, and they are keeping record of all these transactions for their control purposes. So we'll move to the next slide. Okay. So now we'll talk about the filing requirement for estate and the gift tax. So when wealth transfer must be reported to the IRS. So estate and gift tax returns are required when a large wealth transfer occurs, either during the lifetime or after the death. For a gift tax filing requirement during the lifetime, so individual must file a gift tax return when gift to any person, one person exceeds the annual exclusion limit. So exclusion limit is 70,000 per recipient per year, and this needs to be filed by the payer of the gift or person who is giving the gift. So if gift exceeds this amount, the return is required to be filed. So example, gift to a friend is 15,000, below annual exclusion, so no return is required. Gift to a child 50,000, annual exclusion is 70,000, taxable gift is 33,000, must file the return 709. So in case of estate tax filing requirement after death, so executor of the estate must file the estate return if estate value exceeds the exemption limit, and that exemption limit is 13 million at the time of death, which is 13 million per person. So only estates above this must file the return. So as example, no filing is required if estate value is $5 million. Below exemption, so no state tax return. Example, while for filing required is for cases wherein estate value is $15 million, exemption is 13 million, taxable is 2 million, and then it has to file the return. So for large gift given, filing required, yes. Large estate transfer, yes. Gift received, no filing required. Inheritance received, no filing required. So which means that obligation to file the return is on the estate of the deceased, and in the case of the estate tax, and for a gift tax, it is on the person who is giving the gift, not the person who is receiving the gift. So we'll move to the next slide. Okay, now we'll quickly have a look at the excise tax filing requirement. So though we have mentioned earlier as well that we are going to look at excise tax as an overview for academic purpose, we are not going to do any deep dive on the excise tax. Our deep dive session that we're going to follow in the upcoming session is largely to cover federal income tax, capital gain tax, corporate tax, estate and gift tax. These are the taxes which you're going to cover, and definitely payroll taxes, which you're going to cover in deep as we move forward. But for excise tax, this is only for academic purposes to understand what excise tax is being done there, and then who has to file the return and what is the frequency. So we discussed about all this in the last slide. In the last chapter, when we talk about the frequency, in this slide, we'll quickly have a look at the return that needs to be filed for the excise tax. So for excise tax, when businesses must file the tax return, Federal excise tax applies to specific goods and services in the industry. So businesses dealing with these activity must file the excise tax return regularly. So who must file the federal excise tax returns? So business must file if they manufacture the excise good, import the excise good, sell the excise product, and provide the excise taxable services. So main filing form is form number 720. So quarterly federal excise tax return is required. So major activities triggering requirement is that fuel and energy business. So gasoline and the diesel producers, importers, aviation fuel suppliers, alternative fuel sellers must file the 720 quarterly. Alcohol and tobacco industries, air transportation and businesses needs to file the return for the excise. This is largely for the academic purposes, and we are not going to touch in detail for excise tax specifically. So we move to the next slide. Continuation to the last slide. So even heavy vehicle and the highway use, so environmental and chemical industry and the indoor training services. So all these six category of the products or the services are there on which excise needs to be paid, and the individual has to form the or businesses has to file the form number 720 quarterly, just to make sure that they are filing this information correctly with the tax jurisdiction. So they have to deposit the form 720, which is excise tax deposit quarterly, and then they have to file this form, and then they have to deposit the excise tax, which is semi-monthly in the many cases. So with this slide, we largely come to the end of this chapter. So the objective of this chapter is to showcase all the various category of the tax filer, and just to make sure that that tax filing event in US is not equal to the paying of the taxes. So paying of taxes and the return filing are two independent events that needs to be complied regularly, and failure to file the returns will invoke the penalty, interest, and the maybe proceedings, legal proceedings as well for the towards the SSC. So we'll move to the final wrap up slide then. Okay, so if we quickly, do a quick wrap up in terms of what we have understood in this chapter. So we understood about the filing requirement. We understood that filing requirement is not equal to paying taxes. Many taxpayer must file the return even if no tax is owed. So filing ensures the legal compliances, claiming tax refunds, accurate reporting to the IRS. We learned the IRS recognizes multiple taxpayer categories, which includes individual, self-employment and business, corporation, investor, employers, and then estate and gift givers. We also understood the income threshold concept, that individual must file when the gross income exceeds IRS threshold, or special situation applies like self-employment, which includes if income exceeds $400, then we have to file the return. We also had a look at the important exception wherein filing may still required even below the low income if you are self-employed, sold investment property, want to claim tax refund, received advance tax benefit, and owe special taxes. Then we also had a look at that business and investor must file regularly. Filing is required for the business and the corporation, investments in the capital gain transaction, large gift receipts, and the excise taxable industries. So with this, we'll come to the end of this chapter. We are going to have another chapter coming very soon, which is going to talk about the major concept, which is the residential status, and who are required to file the return. So we'll move to the final. Thank you slide. Okay, so with this, we come to the end of this chapter. So if you have any comments, any suggestions, please write me in the comment section. And please subscribe our channel, like this video, watch this video, and share this video to all the individuals who want to have the understanding on the US taxation. So we are going to come with the new chapter very soon on the residential status. So thank you and have a great day.